For decades, our country has been looted, pillaged, raped, and plundered by nations near and far, both friend and foe alike. My fellow Americans, this is Liberation Day.
On April 2nd, 2025, President Trump imposed a 25% tariff on any country importing Venezuelan oil, marking the latest escalation in his administration's use of trade policy to pursue geopolitical objectives. This measure, announced in late March and taking effect with little warning, was designed to choke off revenue to the Maduro regime in Caracas, yet it instantly reverberated through global oil markets and sent ripples across U.S. energy producers. Domestic benchmarks that had enjoyed relative stability began to wobble, as traders and executives alike scrambled to recalibrate forecasts built on assumptions of unfettered commerce. Within hours of the tariff's enactment, crude futures traded sharply lower, illustrating how even targeted trade measures against a third-party supplier can unsettle the broader marketplace. Before we start, smash the like and subscribe buttons for more updates. In the days immediately following the tariff announcement, West Texas Intermediate WTI plunged below $60 a barrel, its first breach of that level since April 2021. That slide represented roughly a 15% drop from the highs earlier in the week, and it underscored how swiftly policy shocks can amplify existing market anxieties. For U.S. producers, especially those whose break-even costs cluster around the mid-$60 range, such swings threaten profitability and force a reevaluation of drilling plans. At the same time, refiners confronted the prospect of sourcing more expensive crude or passing higher costs to consumers, compounding the impact on gasoline prices at the pump and everyday budgets. Almost immediately, however, a diplomatic twist offered a reprieve. On April 9th, Mr. Trump announced a 90-day pause on the new tariffs for all but China, even as he simultaneously raised punitive duties on Beijing to 125%. Oil prices, which had been languishing, rebounded by over 4% intraday, with Brent crude climbing back towards $65 a barrel and WTI recouping gains to hover around $62.35. This rapid reversal illustrated not only the market's sensitivity to policy signals, but also the fine line between strategic leverage and self-inflicted pain. By granting an olive branch to most U.S. trading partners, the administration managed to steady at least one leg of the market's uncertain footing. Yet volatility did not dissipate. Rather, it found new outlets in the trading pits. In the second quarter of 2025, futures and options on the Intercontinental Exchange ICE surged to record volumes as participants sought to hedge against abrupt policy shifts and geopolitical flashpoints. Overall, trading reached 219.3 million lots, a dramatic rise from 181.5 million in the first quarter. Analysts attribute this frenzy to layered uncertainties: the prospect of revived U.S. sanctions on Russia, the ongoing trade skirmish with China, and OPEC, plus decisions amidst Middle East tensions. For U.S. producers and consumers alike, the trading frenzy offered both a risk management tool and a stark reminder of how policymaking can stoke wild price gyrations. Beyond trading desks, global consumption trends also shifted. The International Energy Agency projected that world oil demand growth would slow to its weakest pace in years, in part because trade frictions were dampening economic activity. According to the IEA, the mere threat of higher tariffs contributed to cautious investment in manufacturing and transport sectors, translating into lower fuel use across multiple regions. This erosion in demand growth weighed on price expectations and fed into U.S. inventory builds, as refiners ran output against softer consumption. In this feedback loop, policy-induced uncertainty in one country rippled through the global system, highlighting the interconnected nature of modern energy markets. At the heart of the domestic response has been a cautious stance on drilling and production expansion. Despite President Trump's repeated calls to drill, baby, drill, many operators, especially in core areas like the Permian Basin, have hesitated to ramp up activity. Companies drawing up budgets for the second half of 2025 have flagged margin pressures, pointing out that sustained prices in the mid-$60 range are necessary for new wells to pencil out. Those calculations incorporate not only the direct cost of extraction, but also the expense of hedging against future price dips and the potential for further policy shifts. As a result, U.S. rig counts have plateaued, ending a multi-year ascent that had vaulted the nation to its position as the world's top oil producer. A telling snapshot of executive sentiment emerged in the Federal Reserve Bank of Dallas's Q2 Energy Survey. For the first time in several quarters, the business activity index among exploration and production firms dipped into negative territory, signaling contraction rather than growth. Nearly half of respondents indicated plans to drill fewer wells in 2025, citing not only price volatility, but also regulatory uncertainty stemming from trade policy. The survey covered key regions across Texas, southern New Mexico, and northern Louisiana, areas responsible for a significant share of U.S. crude output. With production forecasts skewing lower, even a slight slide to $50 a barrel could prompt more drastic cutbacks, threatening to erode the gains of America's shale revolution. Stock performance among oil and gas producers mirrored these headwinds. Following the April tariff announcement, sector equities plunged by an average of 15% before a brief rally during the tariff pause. Small and mid-sized independents, lacking the balance sheets of integrated majors, saw the sharpest declines as investors recalibrated risk premia. Credit spreads widened, and borrowing costs ticked upward, complicating financing for new projects. Even when prices recovered modestly, uncertainty over policy enforcement and potential reinstatement of punitive duties kept valuations suppressed. For energy executives, the message was clear. Traditional drivers of growth, rapid drilling and aggressive leverage, are out of favor in a landscape defined by policy whiplash. This caution extends to the capital markets, where some lenders have grown reluctant to back exploration and production loans without stringent hedging requirements. Banks and private lenders have increasingly demanded that borrowers lock in a portion of their future output via derivatives to safeguard against further tariff-induced swings. Such conditions raise the all-in cost of new wells and may delay projects that were marginal under more benign scenarios. In turn, those delays could throttle the supply growth that once promised energy independence, underscoring how trade policy reverberates through multiple layers of the industry's value chain. Despite the turbulence, the United States remains a powerhouse exporter of crude and refined products, a status forged during the Trump administration's deregulatory push in 2017, and sustained by technological advances in hydraulic fracturing and horizontal drilling. Weekly EIA data show exports hovering near record highs, even as domestic prices oscillate. Yet broader export growth now faces two headwinds: retaliatory trade measures abroad and logistical bottlenecks at home. Ports on the Gulf Coast have reported delays as storage tanks fill amid inconsistent refining runs, a symptom of processors matching output to unpredictable demand. Tank farms from Cushing to Baton Rouge have swelled with excess supply during periods of price decline, driving storage differentials that occasionally invert the WTI Brent spread. An inverted spread often signals a market flush with oil, prompting producers to store rather than sell, which in turn compounds the inventory overhang. With inventories near 5-year highs for this season, some traders have speculated about the return of so-called contango conditions, where future delivery contracts cost more than spot markets. While contango can benefit storage operators, it also reflects a market grappling with excess supply, a condition exacerbated by policy-driven demand uncertainty. Internationally, OPEC Plus continues to wield outsized influence, having recently agreed to modest output increases for July 2025. Those decisions, driven as much by fractious cartel politics as by supply-demand fundamentals, intersect with U.S. policy maneuvers to shape global flows. When Middle East tensions spike, as they did in June amid clashes between Israel and Iran, prices briefly touched 6-month highs above $78 for Brent. Yet each spike has been met with swift profit-taking and hedging, revealing a market attuned to headline risk but hesitant to commit to sustained uptrends without clearer demand signals. Looking ahead, the evolution of U.S. oil dynamics will hinge on the duration and scope of trade policies. Should the administration extend or expand tariffs beyond the initial 90-day pause, producers may defer long-cycle investments in offshore and unconventional plays. Conversely, a rollback tied to broader trade agreements could unleash pent-up drilling activity and restore business confidence. Energy strategists stress that sustained prices in the mid-$60 range are vital for balancing the books of most shale operators. Anything below $60 risks curtailing production growth, while much above $70 could reignite spending in a sector still scarred by past oversupply shocks. Policy interplay on the regulatory front adds another layer of complexity. If you liked this video, please give it a like and subscribe to our channel. Also, leave your comments below and tell us, what are your thoughts on US oil prices after Trump's tariffs? We want to hear from you. Thank you for watching and see you next time.